Now speaking, Greg Hayes, Chairman and Chief Executive Officer. RTX had a strong quarter with continued strength across all end markets. On the commercial aerospace side, 1,200 new orders were announced at the Paris Air Show, the largest number in the show's history. Global commercial air traffic is tracking at 95% of 2019 levels, and long-haul international is showing strong growth with passenger flight hours up 18 points year-over-year. On the defense side, the House Defense Appropriation Bill fully funds many of RTX's programs, including the F-135 engine core upgrade. Additionally, the State Department approved a large sale of advanced air defense systems for Poland. RTX saw $25 billion of new orders in the quarter, bringing its total backlog to a record $185 billion. Collins and Pratt content on the aircraft orders will be about $20 billion for the life of the programs. RTX captured $13 billion in new bookings in the quarter, driving a strong book-to-bill of 1.22. Awards included $2 billion at Pratt & Whitney for the Lot 17 of the F-135 engines and $1.5 billion for 117 sustainment. Raytheon was awarded its largest ever MRAM contract for $1.2 billion from the U.S. Air Force and international partners. RTX is working through an issue resulting from a rare condition in powdered metal that will require Pratt & Whitney to remove some engines from service for inspection earlier than expected. RTX raised its full-year outlook to $73 billion to $74 billion and adjusted EPS range by a nickel to $4.95 to $5.05. However, it reduced its 2023 cash flow expectations by $500 million to $4.3 billion. RTX agreed to divest Collins' actuation business to Safran, with proceeds from the transaction expected to be about $1.8 billion. Now speaking, Neil Mitchell, Chief Financial Officer. Thanks, Greg. Our Q2 results demonstrate our continued strong performance across all four of our segments. We reported sales of $18.3 billion, up 13% organically, and adjusted earnings per share of $1.29, up 11% year-over-year. Free cash flow of $193 million was generally in line with expectations. We repurchased $596 million in shares, putting us at about $1.2 billion year-to-date, on track for $3 billion in share repurchases for the full year. Our four segments reported strong growth in the quarter. RMD had sales of $4 billion, up 12% on an adjusted basis and 13% organically, driven by higher volume from air power, advanced technology in land warfare and air defense programs. Adjusted operating profit of $427 million was up $79 million versus the prior year. R&S had sales of $3.7 billion, up 2% on an adjusted and organic basis, driven by higher revenue from sensing and effects, as well as cyber and services programs. Adjusted operating profit of $297 million was down $18 million versus prior year. Collins had sales of $5.9 billion, up 17% on an adjusted and organic basis, driven primarily by strong demand across commercial aerospace end markets. Adjusted operating profit of $837 million was up $220 million or 36% from the prior year. Pratt & Whitney had sales of $5.7 billion, up 15% on an adjusted and organic basis with sales growth across the commercial segments, partially offset by lower military volume. Adjusted operating profit of $436 million was up $133 million from prior year. Overall, we are pleased with our performance in the quarter and remain focused on delivering long-term value for our shareholders. Now speaking, Chris Calio, Chief Operating Officer. Pratt has determined that a rare condition in powdered metal used to manufacture certain engine parts may reduce the life of those parts. As a result, Pratt has instituted enhanced inspections to be performed at scheduled shop visits and has now determined that the timing of these shop visits needs to be accelerated. The PW1100 engine fleet, which powers the A320neo, will experience the most significant impact due to production volumes during this period. Approximately 200 PW1100 engines will be removed for enhanced inspection by mid-September, with an additional 1,000 engines expected to be removed from the operating fleet for this inspection within the next 9 to 12 months. Current production of powdered metal parts is not impacted, and Pratt will continue to deliver both new engines and new spare parts across all product lines. Financial impact associated with these removals is still being analyzed and will depend on a number of factors. Safety is Pratt's number one priority and they will never compromise on ensuring the safe operation of their fleet. Now speaking, Neil Mitchell, Chief Financial Officer. Thanks, Chris. Our outlook for the year is strong, with sales expected to grow between 9% and 10% and adjusted EPS of between $4.95 and $5.05. We are seeing strong commercial aftermarket demand across all segments, and we are increasing our sales range for Collins from up low double digits to a new range of up low double digits to low teens. We expect Pratt's operating profit to be between $200 million and $275 million, and Collins' adjusted operating profit to be up between $825 million and $875 million. For the new Raytheon segment, we expect sales to grow low to mid-single digits and adjusted operating profit to be up between $125 million and $175 million. We are also tightening our adjusted earnings per share range by 5 cents on the bottom end. However, due to the Pratt matter, we now see free cash flow of approximately $4.3 billion for the year, about $500 million below our prior outlook. Now speaking, Greg Hayes, Chairman and Chief Executive Officer. We had a very successful second quarter with $25 billion in new orders, bringing our backlog to a record $185 billion. Sales were also strong with 13% organic revenue growth. This reflects the strength in both our commercial aero and defense markets. RPMs are expected to return to pre-COVID levels by the end of 2023, and military spending is increasing globally due to Russia's aggression in Ukraine and emerging threats in the Indo-Pacific theater. We are confident that we will be able to meet our commitments for 2023 and beyond. Vertical Research Partners analyst Robert Stallard inquired, what is the root cause linking the three issues Pratt & Whitney is currently dealing with, and are you concerned about the potential impact on their reputation for reliability? Chris Callio replied, I'm sorry to report that we have encountered a manufacturing process issue with our powdered metal that has impacted our customers. We have a strong process of fleet surveillance, evaluation, and corrective action in place to ensure safety. We quickly identified the issue and enhanced our processes and inspection techniques to prevent it from happening again. We are now working to define the work scope and turnaround time required to address the impact on the fleet. We remain committed to investing in the GTF and its architecture for the future. Wolfe Research analyst Miles Walton inquired, can you provide more clarity on the scaling of the $500 million lower free cash flow to the total population of engines that you're removing and inspecting? How does the 200 engines in the guidance relate to the 1,200 population, and should we expect a similar sized cash impact in 24? Neil Mitchell replied, I can tell you that we have begun to investigate the cost, work scope and timing associated with the 200 accelerated inspections. We anticipate that 85% of the fleet is under long-term contracts and we are less than 5% complete on those programs on average. This should help keep the P&L impact manageable for the year. We are still assessing the cash flow implications, both direct and indirect, such as accelerated capital, inventory, expenses and customer disruption. We will provide a better update in the next couple of months. Wolfe Research analyst Miles Walton inquired, can you provide more information on the powder metal supplier? Greg Hayes replied, yes, we manufacture a proprietary powder in our New York facility and process it into turbine discs at our Columbus, Georgia forge. Bank of America Merrill Lynch analyst Ronald Epstein inquired, Greg, what communication issues have been identified in the engineering workforce that may have contributed to the engine issues? How were these issues not identified prior to the investor event in Paris? Greg Hayes replied, Ron, we uncovered a manufacturing quality issue with the V2500 turbine disc back in 2020. We determined that there was contamination in the powdered metal used to make the discs. We inspected the entire fleet of Pratt products manufactured between late 2015 and early 2021 and found a very small fallout rate of less than 1%. We recently updated our safety risk assessment and determined that we need to inspect an additional 1,200 engines over the next year. This is not a design issue, but rather a quality escape from manufacturing. We are taking the necessary steps to ensure the safety of the fleet and will make the airlines whole for any disruption caused. Robert W. Baird & Company analyst Peter Arment inquired, Greg, when did you make the change to powdered metal? Was it in 2020 or 2021? Greg Hayes replied, we identified a contaminant in our powdered metal production process in mid to late 2021. We took steps to eliminate the contaminant, which is microscopic, and we believe that almost all of the product shipped in the last 3 years is going to be fine. We are confident that we can continue to support Airbus and our customers with new deliveries and spares this year and next. Jefferies analyst Sheila Kahyaoglu inquired, can you walk us through the drivers of the $1.2 billion free cash flow usage in the first half and the $4.3 billion expectation for the year? What are the biggest working capital impacts, and what should we expect from factoring in Pratt engine sales? Neil Mitchell replied, our second half of the year is consistent with our expectations. We anticipate a segment operating profit of around $4 billion, a capital headwind of $1.4 billion, and a working capital outflow of $3.5 billion, split between inventory and net contract asset liabilities. We also expect to see pension, taxes, interest, and other expenses of around $0.5 billion. The Pratt impact will mostly affect working capital. Morgan Stanley analyst Christine Liwag inquired, what is the outlook for free cash flow in 2025 given the Pratt issue, and what potential downside risks should we consider? Neil Mitchell replied, good morning, Christine. The issue we discussed will likely put pressure on Pratt's margins and cash flow. It's too early to provide an exact figure, but we'll be taking the time to assess the scope of the work and how it fits into our existing plans. We're always looking for ways to maximize efficiency, and we'll do the same here. We'll provide more details in the coming months. Greg Hayes replied, "We are pulling back 200 engines this year, with many already planned. We are accelerating tooling and dedicating spares to a rotable pool of engines to support customers. We will have 19 MRO facilities by the middle of next year. We are working through compensation to airlines with special support agreements. By the end of next year, the inspection program will be almost complete. The 2025 outlook should not be impacted, other than potential margin impact from costs associated with GTF support contracts." JP Morgan Chase & Company analyst Seth Seifman inquired, "Can you provide some insight into the expected profit growth at Raytheon and the top-line momentum at RMD in the second half?" Chris Callio replied, "Seth, when it comes to RMD, we're seeing positive momentum in terms of material growth, up 14% year-over-year. Kit fill rates, which had been in the mid to low 50s, are now in the mid-70s. At Reese, we're seeing good material flow and kit fill rates, but we're still working through some fixed-price development contracts that are technologically complex. We expect to make significant progress on those in 2023 and early 2024. Neil Mitchell replied, "We saw encouraging signs in the first half of the year, with our combined business essentially flat year-over-year. We expect to see a $100 million productivity step up in the second half of the year, with $75 million of that coming from material receipts. We're seeing an uptick in sales at the missile business, and the mix of production is transitioning from development to 2023, which is the low point. We've taken into account the first half performance as we've readjusted our outlook for the second half of the year." RBC Capital Markets analyst Ken Herbert inquired, "What are the primary risks and greatest unknowns associated with the 1,000 engine diversion into the spare pool and its potential impact on cash?" Chris Callio replied, "Ken, as we noted upfront, there are a number of variables that go into the fleet impact. We're working to define the work scope, optimize the network capacity, and minimize disruption on other programs. We're still developing the optimization formula, but we're confident that we can do this work quickly and efficiently." Citi analyst Jason Gursky inquired, "Can you discuss the internal manufacturing capabilities of the MRO and how it may affect GTF production?" Chris Callio replied, "Thanks, Jason. We've had an enhanced inspection technique in place for some time and have conducted almost 3,000 inspections on the V2500. The fallout rate from these inspections has been very low, so we don't believe the HPT will be a limiting factor in our ability to work through this quickly and efficiently." Citi analyst Jason Gursky inquired, "What is the timeline for completing an inspection today?" Chris Callio replied, "So, Jason, HPT discs require the engine to be removed from the wing in order to inspect and reassemble. We're working to make this a project visit instead of a full interval shop visit, which would reduce the wing-to-wing turnaround time. This is important for understanding the fleet impact and network requirements." Citi analyst Jason Gursky inquired, "Can you discuss any potential benefits of the inspections in terms of optimizing durability swap-outs?" Chris Callio replied, "When it comes to the 2024 shop visit population, we'll be assessing utilization and cycle time on those engines. We'll work with our customers to make a mutual decision on whether a project visit is the right candidate or if the work scope should be increased to benefit the time on wing and the interval of the engine in the future. This is part of the equation that will be discussed once we understand how many of these visits are truly incremental in 2024 and the related fleet impacts." Citi analyst Jason Gursky inquired, "Do you anticipate having more clarity on the subject by the October earnings call?" Greg Hayes replied, "Jason, we're making progress every day. We anticipate having the first 200 engines inspected and returned by mid-September. By then, we'll have a better understanding of the inspection protocols, turn times and customer requirements. By October, we'll have even more knowledge and be able to provide an update on the cost and cash flow impacts. We expect to have a much clearer picture by the time of our third quarter earnings call." Cohen and Company analyst Kai von Rumor inquired, "What is the expected number of GTFs delivered by mid-2021 and is this related to the PW1000 or the Versus?" Chris Callio replied, "Our current assessment is that we don't expect the same type of impact on the V2500 engine as we have seen with the 1100. We have an enhanced inspection fleet plan and management plan in place, and have completed a significant number of inspections. We are still analyzing the other NEO applications, but our current expectation is that they can be managed within the existing shop visit forecast for 2024. We have also put in place enhanced processes for powdered metal and inspection techniques, and all engines that have come off since then have gone through this inspection. We will inspect parts when they come in for their normal shop visit, and we feel confident that the Safety Management Board at Pratt has the right population and plan in place." Cohen and Company analyst Kai von Rumor inquired, can you provide an outlook on the munitions market in the out years, given the recent $2.9 billion MRAM order from Germany? Greg Hayes replied, Kai, the MRAM order is for NATO countries, including Ukraine, and we expect a large order for GEM-T missiles associated with the Patriot air defense system. We have orders from Saudi Arabia and NATO, and in the back half of the year we anticipate significant order intake for MRAM, GEM-T, and Excalibur. We've already seen $2 billion of orders related to Ukraine replenishment, and we expect another $2.5 billion in the next 12 months. We're bullish on the defense outlook for the next couple of years. At this point, we are in close coordination with the regulatory bodies and have submitted our plan for review. We are confident that our plan is sound and will meet all necessary requirements. We do not anticipate any risk of accelerated population or timeline of inspections. Chris Callio replied, we've been working closely with the FAA on this issue. We use a safety management process to identify and assess potential risks, which includes events in the field, continuous surveillance, and recommendations like this one. We coordinate with the FAA and other international regulatory bodies to ensure our processes are up to date. Barclays analyst David Strauss inquired, what is your assumed fallout rate for replacing the high-pressure turbine discs? How much more involved and costly is it to replace the blades versus just the inspection? Chris Callio replied, you're right, David. Our inspection process has revealed a low fallout rate, meaning that the turbines we inspect don't need to be replaced. We anticipate this trend to continue, and our assumptions reflect that. Greg Hayes replied, David, the inspection process requires us to remove the high-pressure turbine disc from the engine and put it through a protocol. The impact of replacing the disc with a new one is minimal, and the expected fallout ratio is very low. We have plenty of capacity for turbine discs out of Columbus, so this is the most manageable portion of the process. Goldman Sachs analyst Noah Papanak inquired, can you provide an update on the free cash impact of powdered metal next year and the fixed-price development programs you're citing? What are they, when do they move out of the development phase, and how do they affect your margin expansion expectations? Neil Mitchell replied, in response to the question about free cash flow and defense margins, I can confirm that we need more time to put a finer point on our estimates for free cash flow in 24 and beyond. As for defense margins, we expected $40 million to $50 million of headwinds from the R&S business, which happened as expected. Most of these contracts are classified, but the duration is likely 18 to 24 months before they are fully behind us. We have the right resources on it and have calibrated it in our second half of the year outlook. Absent this, we are seeing productivity turn in the rest of the business. Greg Hayes replied, thanks for joining us today. It's important to keep in mind that RTX has strong franchises in Collins, Raytheon, and Pratt & Whitney, with a $185 billion backlog. We recently encountered an unexpected quality issue with the GTF engine, which we've been working on for the past 10 days. We'll have more information in the next 6 weeks and we'll be sure to share it with investors. Jennifer and her team are available to answer any follow-up questions you may have. Thank you for your time and have a great day.